All right, today we're going to discuss auditing debt, long-term liabilities, and equity. Essentially, debt and equity are how companies meet their long-term financing needs. So in debt, they promise to repay a lender. In equity, they actually give ownership interest into the company so that they'll get some sort of funding that they require. Now here's my Tim cert for this video. Good financial condition usually means matching the length of time of the debt instrument with the procured item's length of service time. So for example, if you buy a house, which is a long-term asset, you should have a mortgage, which is a long-term liability. If you buy inventory, which is a current asset, you want to use accounts payable, have a current liability. Therefore, be very cautious of companies that are buying current assets with long-term liabilities, and make sure that that are buying long-term assets with cash or short-term liabilities are not putting themselves into some sort of cash flow jail. Now, you can exercise these same principles in your personal life and always strive for a personal quick ratio that's greater than 1, and you should always be in good financial condition. So long-term debt, the basic ways that companies incur this debt is through the issuance of bonds, which are usually like $10,000 notes or something that I promise to pay that $10,000 in 5 years, and I'll give you interest from here till then until I pay that 10,000 off, or just a long-term note with a bank or an individual. The mortgages through a bank, long-term loans. You could have short-term and long-term credit lines, actually, long credit lines that last for longer than a year. And you could inherit the debt through a merger or acquisition. So the company that you're buying or merging into you could have some long-term debt that you're inheriting. So no, organizations usually have only a few debt transactions, but each transaction is usually significant and material to the financial statements. So the accounts that affect long-term debt are usually bonds payable, and then there's an associated bond premium or discount with that bond, depending on whether the bond has a interest rate that's higher or lower than the market rate. You'll have a notes payable out there, usually a long-term notes payable to be in long-term debt. A mortgage payable. You'll have associated interest expense and even interest payable accounts that are affected. You'll have gains or losses on the refinancing of debt, and you'll also come across something called the current portion of long-term debt. So you'll have all your long-term debt, you'll pull out your current portion and put that into the current side of your liabilities. So the assertions when auditing long-term debt are all the debt obligations recorded on the financial statements. Now, you remember Enron misused off-balance sheet financing to hide long-term debt. They moved them into false sales, and then that entity would have a debt on their books that they didn't consolidate. So they hid that off-balance sheet financing. So assertions that are important to long-term debt are the completeness. Are, the auditor is very concerned with the understatement, so it's important to ensure that all debt transactions are being recorded and ensure that interest expenses being recorded are in the correct period and at the proper amounts. You want to make sure that the valuation is correct. So proper valuation of premiums and discounts along with the amortization related to that. And then finally, the presentation and disclosure of all the debt so that you're aware of any debt restrictions, or the users of the financial statements are aware of all the debt covenants, the debt restrictions that will be on the company for the payment terms of its debt. So fraud risks related to debt are the concealment of that long-term debt or related debt covenants that are required for the company to maintain. So misclassifying long-term debt as short-term debt, obtaining long-term debt without proper authorizations, and then not recording any prepayment penalties. So the big one are the first three there, that concealing of debt or misclassifying debt, or again, getting into agreements for debt that the other management or the board is not aware of. So to try to prevent this, some of the proper controls related to debt would making sure that the board of directors has approved all debt. They should have debt schedules, amortization schedules, interest accounts, make sure they're all updated and reconciled to the ledger on a monthly basis. Some of these debt schedules can be pretty intense. And then top management and board of director approval of financial statements prior to the issuance for proper disclosures related to debt covenants on those financial statements. When we talk about the equity side of things, the most common accounts are common stock, preferred stock, treasury stock, additional paid in capital, which there could be additional paid in capital common shares, additional paid in capital preferred stock, and additional paid in capital treasury stock. You've got your retained earnings account, and then additionally you'll have things like dividends, options, accumulated other comprehensive income. And if you're dealing with schools, governments, or not-for-profits, you'll have fund balances, which are the same as equity accounts. And you might have to deal with tax certiorari accounts, which are related to the fact that you're in a lawsuit and you're probably going to have to give back taxes that were collected on property for an entity that you're in lawsuit with. So you're actually reserving that amount. And you can have other types of reserves in fund balances. So there's definitely more extensive review of fund balance accounts when you're in that not-for-profit, government, or school arena. But just the same, there's a lot to review as an auditor in equity accounts. The usual equity transactions include issuing stock, purchasing treasury stock, declaring and paying those dividends out to stockholders, granting stock options or warrants. Warrants can be part with debt and that stock warrant, so that's something that there'll be a calculation on split that you have to review. Exercising and accounting for the expiration of those stock warrants or even those options. Income loss that affects retained earnings. You'll have that accumulated other comprehensive income, the equity portion of those transactions, like unrealized gains and losses, deferred pension and post-retirement costs that you need to reflect in there. You'll have prior period adjustments that may be found during the audit or identified by the client that need to be recorded. And for government schools and not-for-profits, you'll have those reserve balances and the changes in those reserve balances based on whatever the board approves. Now, the assertions related to equity, the big one is valuation. Auditors' primary concern is the proper valuation of equity accounts. So the issuance of cash is straightforward. But when stock is used to acquire, the market value of the stock compared to the market value of the acquired asset or entity requires oversight of that valuation to make sure that you have the proper accounting and that it was conducted in the correct way and in compliance with GAAP. You have stock options that are out there for you've got to have periodic expenses that you're recording, the exercising of those options, the expiration of those options, and the stock warrants. The presentation and disclosure is very important. So are all the items properly classified and presented? Any restrictions on fund balances or reserves that need to be disclosed? All that's part of the presentation and disclosure assertion. When it comes to the inherent risks of equity, compliance with bylaws is a concern related to the issuance of sales of shares or related to issuing options, warrants, or even declaring dividends. Have they followed the guidelines? When the company gives away an equity position, they may not receive the compensation they were expecting to receive. There's a side deal going on that may have been given away, so you want to make sure that compensation is received. Now, improper valuation of transactions or incorrect amortization calculations is another risk. You could have improper classification of transactions, such as a stock buyback, where it's not recorded as treasury stock as it should be. And then finally, transactions could be recorded in the wrong period. So fraud risks related to equity mainly concerned with the lack of approvals. Lack of approval for issuing stock, you didn't get approval for conducting a stock sale, and maybe you exercise unauthorized stock options, all in no-nos, potential fraud risk. Improperly recording stock sales, issuance, and options, those could be a problem. And then finally, violating the debt covenants purposefully through stock sales or issuance. There might be some debt covenants where you're supposed to have certain ownership, and if you have given away or sold stock in a way that has violated those debt covenants, that could be a risk of fraud. Now, the key controls when it comes to equity are board of director approval for all types of stock transactions. Stockholder equity accounts are updated and reconciled to the general ledger on a timely basis. You also need skilled accounting personnel to analyze and record stock option grants with oversight by top management and even legal counsel. Top management and board of directors review of the financial statements before the issuance for proper equity account disclosures, and an outside party, such as an attorney, maintains details of shares issues, repurchases, or canceled shares. All those are maintained by an outside party. All right, so now you're planning for the audit and you're going to do your analytical procedures. So when it comes to debt, you're going to compare the notes payable and accrued interest balances to the prior years and understand any significant deviations. You want to estimate what you think the interest expense should be based on average interest rates and the client's current debt outstanding. Calculate and trend to prior years the debt to equity ratio of the client and the interest earned ratio of the client, interest times earned ratio of the client. So that's what you want to calculate, figure out, look at the prior years and compare. And then finally, equity, the primary analytical procedure is to compare current equity balances for all the different accounts with prior year balances, just again for significant changes. The substantive tests you'll perform on an audit related to debt, you could be reading loan agreements, new loan agreements, and identifying any changes in existing loan agreements. Confirmation of any debt obligations and covenants with third parties. Could be obtaining the schedule of debt obligations and the interest for review and recalculation. Sometimes these will be on Excel spreadsheets. Could be massive depending on what type of customer or client you're dealing and how much debt obligations they have out there. You're going to trace bank transactions for new debt proceeds from the cash receipts right onto the bank statements. And you'll trace any disbursements of debt payments by examining either check disbursements. A lot of times they're electronic funds transfers now, and right on through to the bank statement so you see them performed. On the equity side of things, some of the substantive tests you might do on an audit are reviewing the articles of incorporation for relevant information related to each class of stock, obtain and review the client-prepared analysis of the stock transactions, review board minutes. You'll be looking right through board minutes, reading to see if there's been approvals for these stock-related issuances or repurchases. You'll trace the proceeds of issuances to the cash receipts and then back onto the general ledger so everything has been recorded properly. You'll review those transactions for the proper recording and valuation of the entries affecting those equity accounts. And finally, you'll ensure that all non-cash equity transactions are in compliance with GAAP. Now, related to some specific areas within equity, the substantive tests might include for treasury stock, you could examine documentation of the share transactions. You could confirm transactions with the stock agent. When it comes to dividends, you want to review those board minutes and again, make sure they have authorized that dividend and put in a declaration date, a record date, a payment date, because the declaration date is going to affect your liability. The payment date is going to affect the ultimate payment of those dividends. Review the disbursement for the dividends, whether done by the client or confirmed through an agent to the client, and agree with the authorized amounts that the board had approved. And finally, review retained earnings. This should always tie out. Any journal entries that you see in retained earnings should really be scrutinized. In the not-for-profit, government, and school area, they will move money around within the retained earnings or the fund balance accounts to reflect reserves. But in a corporation, there should be nothing that really happens to retained earnings other than if there's special transactions related to dividends or the natural income or loss affecting that retained earnings annually. So that could be a financial fraud that's being hidden if you see a transaction you're not expecting to see in retained earnings. Let's say now you're on a fraud-related scenario. You're going to do a lot of the same steps you would do during an audit, except for in that fraud scenario, you're going to have more professional skepticism, which means more intense scrutiny of the documents that are required, making sure they're originals. So in debt, you wouldn't do this in an audit, but you would likely do this in a fraud scenario where you're going to search public databases and public records to see if there's some debt obligations out there that have not been identified to you previously. You're going to vouch and trace loan proceeds and debt payments to make sure that ties out. You'll send confirmations to lenders and creditors to see what balances are out there, if there are any loan covenants that you don't know about. You're going to require those original loan documents for review because copies can be altered. And then match details of debt terms with what management knows about, has approved, and has authorized. The fraud scenarios with equity are a little bit different here because you just want to confirm the terms of the equity arrangements and the shares held by shareholders just to make sure something hasn't gone on that everybody's not aware of. Confirm with the shareholders of any side arrangements that have been going on, which hopefully that has all been out in the open and people are aware of and approved and authorized. You're going to send confirmations to transfer agents on stock issuances, and you're just going to confirm and vouch all those proceeds from stock issuances that have occurred. In the last portion of this lecture, we're going to talk about management estimates as it relates to long-term debt. So all of the following must be reviewed to ensure compliance with GAAP and that the client has consistently applied and properly reflected the state of a liability, and that's usually based on whatever terms that management and the board of directors have agreed to related to these areas. But warranty reserves, and we'll talk about these a little more specifically, but pension obligations, if you have a defined benefit plan, you're going to have a projected benefit obligation, and other post-retirement benefits. That's what we'll talk about. When it comes to pension obligations, or OPEB, which is other post-retirement employee benefits like healthcare, the client usually engages an actuarial firm to determine the estimates of what that liability will be for the client. The auditor's concern is always with, is that actuarial firm independent? But more importantly, are they skilled and capable to perform that estimate? A lot of times clients will hire certain actuarial firms that commonly do this. So a lot of CPA firms will be used to dealing with the same actuarial firm that they do with lots of clients. Next, has the information about the plans, all the information been shared with the actuarial firm so that they can have a proper calculation? And then, was the actuarial estimate calculated relevant to the audit period? Sometimes clients will only pay for an every other year estimate of that for that actuarial service. So you just want to make sure that it's relevant to what you're doing when you're preparing the financial statements. So how old is that estimate? How often has it been prepared? So those are some of the basics about pension obligation liabilities and OPEB liabilities.